Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder. Welcome back to another episode of ETF Spotlight here on Seeking Alpha. Today, we are diving into the world of CLOs with the JAAA fund given to you by Janus Henderson. And we are joined by none other than John Kerschner. He's portfolio manager, but also global head of Securitized products over there. We can't thank you enough for the time to dive into this world that not many, just the everyday cuff retail investor might know about in the CLO realm. So really looking forward to our conversation today. I was hoping, John, could we start things off by just maybe talking about the history of this fund, how it was created, and where we are today?
Yeah, thanks, Daniel. Pleasure to be here. Thanks for having me. The history is pretty simple. It's not our first ETF and definitely not our first fixed income ETF. For securitized products, that went to JMBS that we launched in 2018, actually. That came about after I hired Nick Childs, who's my co-PM on both strategies. And we were talking to the head of our ETF group, Nick Cherney. We decided to launch a mortgage fund in an ETF wrapper simply because there was no other actively managed mortgage fund out there in ETF land. And then based on the success of that, and what we saw as very good performance of AAA CLOs during the COVID dislocation, we were looking for another, let's just call it white space in the ETF market where there weren't other products, particularly liquid products out there. And a lot of people don't know this, but AAA CLOs, the minimum amount you can buy is $250,000. So if you're going out and buying an individual CLO, so there was no way for retail money to get into the CLO market without an ETF. So we just looked at it as a place where there was no product. It was very difficult for individual investors to get high quality floating rate fixed income, and the time was very ripe given the performance post-COVID.
Now, some of the retail investors out there, they still don't quite understand the CLO space. They don't know how it might work into their portfolio, but I know you're focused on the capital preservation and the income side of things. Could you talk about that a little bit?
Yeah, I mean, capital preservation is paramount to fixed income, right? Because it's very difficult to make up lost ground, particularly if you have defaults in your portfolio, right? You basically in fixed income are hoping for some kind of income over time and then getting your capital back at the end. Equity is very different in that there's a lot more volatility, but there can be a lot more upside. So we take capital preservation very seriously here at Janus Henderson. And then the income kind of speaks for itself. I think most people who are investing in fixed income want some kind of safety and income to pay their daily or monthly bills. And JAAA, as I said, is one of the really quality instruments for that because it is vast majority AAA, and yet it's still paying out a pretty high yield of about 5.5%. So far this year, JAAA is up right around 3%, and annualized over the last 3 years, it's up about 7.5%. I encourage people to look at their other fixed income portfolios out there and see if they have as good of performance, particularly over the last 3 years. So high quality income, I think, can be a good part of anybody's fixed income portfolio.
I agree with you, John. And I mean, then you have assets under management of $23.03 billion. As we see here on Seeking Alpha's simple page today, yield 5.84%. I mean, you're really focused on that yield and ensuring that it stays there. How do you think to the future and ensure that that's going to be sustainable for months and years to come?
Yeah, so the number that we tell people, and obviously comes with a big degree of caveat because past performance is no guarantee of future returns, but traditionally AAA CLOs over time, so not 1 month or 1 quarter, but over several years, have outperformed cash by about 150 to 175 basis points, so 1.5 to 1.75%. That will likely come down, quite frankly, with the growth of CLO ETFs and as more investors, both institutional and retail, come into the space. So in some respects, we're trying to bring that excess yield down versus other asset classes, and we're okay with that. We get the question, why does it exist? I think there is somewhat of a complexity premium out there. Like you said, a lot of people don't understand CLOs. We've spent a huge amount of time educating investors, going out there and telling the story. But the yield premium is still very high, may gradually come down, but we think that's going to take many, many years, and it'll be a good investment for the time to come.
Yeah, so let's talk about the AAA side of things, of like ultra low duration, that maybe in the holdings, and how interest rates can affect that. I mean, over the most recent years, we all saw the spike in interest rates from the Federal Reserve, and obviously we're in a period of uncertainty, right, as we see with the administration and the Fed and what's to come for interest rates. I think that's on every investor's mind right now. How is this fund positioned for the environment coming, and also how the volatility of the previous interest rate environment we already went through?
Yeah, I really like this question. Look, JAAA kind of proved itself in 2022 when pretty much every fixed income fund out there almost was negative on the year. JAAA was actually positive. So people are asking us, look, the Fed's going to cut rates. Why wouldn't I go into something that's going to perform probably a little bit better if rates are cut? And my response to them is, are you sure the Fed's going to cut rates? I mean, Jay Powell's kind of been holding the line. There are a lot of people out there that think maybe rate cuts don't come till 2026. And we have yet to see kind of the pull through of these tariffs into the inflation numbers. Yes, certain things have remained relatively low as far as inflation goes, like airline tickets and even autos, but we think that's going to reverse. So, it remains to be seen who this administration is going to nominate for the next Fed chair. And yes, short-term interest rates may come down somewhat over the next year. That would be our base case, but it's not guaranteed. And if inflation becomes worse than a lot of people are expecting, Fed could reverse course and start raising rates again. So what I'm telling you this is, just because all the talking heads out there and all the financial shows are saying, the Fed's going to cut rates, it's not guaranteed. And this product, JAAA, is a great hedge to the portfolio, particularly if you own other fixed income that will do very well if rates come down. This product will do fine, but will do even better if rates end up going up over the next year or two.
So putting the portfolio manager hat on, obviously there's a cash position in this fund as well. How do you handle and approach the cash allocation within JAAA?
Yeah, look, we're constantly getting inflows and outflows into the fund. It's big enough now. That shouldn't be a surprise. The first couple of years, we were getting almost all inflows. But now it's looked at a capital markets product, right? There are people that are selling it to go into something more risky in like post-liberation day times. There are certain people that are saying, well, the world's very uncertain and we want certainty. So, but what a lot of people don't understand is that a lot of our flows, probably more than 90% now, are coming in kind. And what that means is we're not getting cash from the market makers. We're either giving shares and giving them CLOs or vice versa. So, for example, during or right post-Liberation Day, I think a lot of market makers out there, basically big Wall Street banks, had clients that wanted to buy AAA CLOs because the dollar prices had come down as spreads had widened out. So, a Wall Street trader out there doesn't want to hold hundreds of millions of of AAA CLOs on its balance sheet because they get charged for a capital cost for that. So they could come to us, JAAA, and say, we want some CLOs, we'll give you back shares. That looks like a withdrawal or a redeem, but really all it is kind of the normal functioning of the capital markets. And so that happened post-Liberation Day. We were at 22 billion AUM. We came down to 20 billion in assets. And now we're, like you said, back up to 23. So we look at it as just very normal. There sometimes will be some cash in the portfolio, but it will be a very, very tiny drag on overall performance. But you might see that go up, that cash percent, in a dislocation like Liberation Day. That's complete normal functioning of the markets.
Yeah, well, so you mentioned the institutional trader, but let's talk about the retail investor, maybe even the group of the baby boomers and everybody entering retirement, thinking about their portfolios and how a fund like yours might be a part of that portfolio diversification. Do you have any thoughts you might be able to share, obviously within, disclaimers of everything, how people should be thinking about how this particular fund could be additional yield or fit within their overall portfolio when they're thinking about diversification?
Yeah, I really like this question as well because, so often people come up to me and say, what should I invest in fixed income? And, that's like going to a sports GM and say, what player should I add to my roster, right? Like, you can't answer that question if you don't see the whole picture, right? You need to know what else the person has in their portfolio. But I almost guarantee you 90+% of investors out there, they'll have some kind for fixed income. Most people own some fixed income, but a lot of it's like an ag-based product, a core plus product, very generic fixed income, nothing wrong with that. Maybe a multi-sector product, again, a little more risk, a little higher yield. What people don't really have, or if they do have something very low risk, it's usually just cash, like T-bills, something like that. And I already gave you the numbers of why we like JAAA versus cash. Little bit more risk for sure, but a lot more return as far as percentage basis. And so when I look at people's portfolio, I say, okay, maybe you have a core plus, a multi-sector, maybe a high yield fund, maybe a global fund. What you don't have is something that's going to do well in an environment like 2022 where rates go up. So people buy fixed income for safety, income, or insurance. And what I mean by insurance is if stocks go down, usually bonds go up. That's what we've seen actually for the last 25 years. Notwithstanding what happened in 2022. And so a lot of people buy fixed income in case stocks go down. But the other two categories, safety and income, can both be given to you by a JAAA. So if you don't have something that's very high quality and floating rate besides just cash, consider JAAA, right? Again, you'll take a little bit more risk, but you should, again, massive caveat there, but you should be getting more return over time. You're definitely getting more current yield of what you're getting paid out every month right now.
Yeah, John, I know we all think about risk and reward. I mean, we all kind of understand that, and it makes total sense. But I want to go back to earlier in the conversation when you mentioned thinking about the future ahead, right? This is how we typically wrap things up is you're in the space. You have all the knowledge. How are you and the team thinking about the next 3 to 5 years of this space? When you mentioned earlier, yeah, there may be more CLO funds that come on the market. How are you keeping that competitive advantage going forward?
Look, we're by far the biggest out there. We're by far the most liquid. I think there were a lot of naysayers that said, okay, JAAA is growing a lot, but as soon as there's a dislocation, you're going to see massive withdrawals, massive redeems. We did not see that. The bid-ask JAAA stayed at a penny. It performed as advertised. So what we're looking for in the future, continue to tell the story, continue to convince the naysayers out there that this product is ready for prime time, has been for several years actually. It belongs in portfolios. And then, maybe we've been launching offshore products that are very similar, a European AAA CLO, a global AAA CLO product, because a lot of offshore investors, when they invest in the US, they have to pay withholding tax. So you'll see more of that and probably more products that are issued off JAAA. There's already options on JAAA. Those will probably come more liquid. So you see these products like SPX or QQQ or JNK or AGG, these are big ETFs out there. And yes, the ETFs are important for people, but then you see derivative products issued off of them. We're going to see a lot more of that for JAAA in the next few years.
Yeah, let's go ahead and wrap it up there. Thank you so much, John Kerschner. Everybody, go check out the JAAA ETF here on Seeking Alpha. You can follow it, add it to your watch list. Maybe it's right for your portfolio. I don't know. It's up to you. But everyone, thank you so much for the conversation, John, and diving into the world of CLOs. And everyone, we will see you here again next week for another episode of ETF Spotlight. Take care.
Thanks, Daniel.